James Shugg, the chief economist of Westpac Banking, is here to tell us how we can interpret the changes in the Libor and what we can expect. Good morning to you.
Good morning.
Now, we were last week looking at a sovereign debt crisis possibly becoming a banking crisis. Is that all over?
Oh, absolutely not. I mean, what we saw on Friday when Libor spiked quite sharply, we view that as a bit of a shot across the bows from the markets to European and IMF authorities to get that package at the weekend right. I mean, funding conditions in markets were terrible on Thursday, Friday last week, particularly after the ECB meeting.
Yes.
European banks were being shunned. You know, interbank lending is unsecured, and there are real worries about those banks. Australian banks, and to a lesser extent the UK banks, not so much shunned, but with those European banks not in the picture, you know, there's a shortage of dollars basically, and that's why Libor pushed up.
Now, of course, you know, after Lehman's, the idea was that banks just didn't trust each other anymore. They didn't trust each other to lend, and that's why you see that rate spiking up. Again, they didn't trust each other at the end of last week.
Not everyone. People I was speaking to were saying it felt just like the early stages of Lehman's, and I think that message has permeated through to the officials, because the whisper word last week was 600 billion euros in terms of the total package. We got 750 billion euros, and more importantly than that, well, as importantly as that, the ECB totally backtracked. They're now going to buy toxic assets, you know, toxic sovereign assets off the banks.
A huge turnaround.
That's right, and they are exiting their exit strategy in terms of, you know, liquidity measures and so on. It's not a monetary policy thing, of course, because it's not like the Bank of England buying bonds, because they are sterilising it, but nevertheless it's going to take bad assets, potentially bad assets, off the banks and take them back into the government sector. The irony being they are government assets.
No, of course, what it doesn't do is it doesn't mean that the austerity package in Greece is going to be any less painful, does it?
Oh, absolutely not. I mean, I've got personal experience of what's happened in Latvia there, and a country with a floating exchange rate too. Hospitals and schools being closed in country areas, people dying, families being turfed out because they can't pay the rent. I'm afraid that's the sort of disaster that's confronting Greece. And if they don't, the risk is that if Spain and Portugal don't put into place a sort of budget cuts that markets are satisfied with, this thing is just going to keep on running.
Now, like the euro at the moment obviously doing well today, but do you think that's a temporary spike?
Well, it all depends on what sort of aggressive budget cuts are put in place in other parts of Europe, because the concern is there's still this niggling concern that maybe what we got over the weekend just may not be enough. So, and also you've got to argue that on many measures the euro's overvalued anyway. So this is merely one catalyst of many that's actually driving the euro down to fairer value.